Ji Hari Om. नारायण के रूप ठीक है सोते हो सुनो तो
एकदा न्ही पळय अशें आमकां आमची सीईपी आसता कळ्ळें न्ही अशें ही सीईपी हातून व्हिडिओ कॉल दिसता लोक एकदां न्ही असो व्हिडिओ चालू अशेंच हे चालू आसलो गो
Good evening. I can't hear.
Uh,
Now I could hear
Good-
something.
Everyone, Kajal madam, please see Chatwani sir has joined or not?
No, sir. He have not joined yet. I'm just calling him.
Oh, okay, okay.
हा ठीक आहे या 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 नवरत्न पाशी या हा रस्ता क्रॉस करून नवरत्न पाशी या नवरत्न आणि TBZ च्या मध्ये उभं राहा
Sir is coming in a minute.
Okay, okay.
Okay, वाला कर दिया इसने?
Chatwani sir, good evening.
Good evening, sir. How are you, sir?
I'm fine. How are you, sir?
I'm fine, sir.
Okay. Can we start, sir, now?
Yeah, sir.
Okay, okay. Kajal madam, please.
Yes, sir. Namaskar and good evening to each one of you connected to this webinar. Respected Mr. Yogesh P. Chatwani, sir, our speaker today, Mr. S.V. Sharma, sir, our chairman, and esteemed participating registered valuers and my colleagues. I, Kajal Gupta, manager of DGVF RBO and coordinator of this webinar, extend a warm welcome to you all on behalf of my organization. As you are aware, the topic of today's webinar is use of Excel for valuation. Excel is a spreadsheet program from Microsoft and a component of its Office product groups for business application. Microsoft Excel enables users to format, organize, and calculate data in a spreadsheet. Excel can be used as tool to conduct valuation by the value. Valuation modeling in Excel may refer to several different types of analysis, including discounted cash flow, DCF analysis, comparable trading multiples, precedent transactions, and ratios such as vertical and horizontal analysis. The various types of analysis may be built from the scratch in Excel or may use an existing templates or models. The topic will be discussed in detail by our speaker today, Mr. Yogesh P. Chatwani, sir. Before I hand over mic to him, I will briefly introduce him to you all. Mr. Yogesh P. Chatwani, sir, is an accomplished practicing professional with very high qualification. He is BCom, MCom, ICWA, CPA, USC. He is a registered valuer and an insolvency professional. He has working experience of over 38 years with IOC, Maharatna and Fortune 500 companies and India's second major port, KPT. He has rich knowledge of indirect taxation, accounting processes, office automation that includes SAP and MS Office. Presently, he is a practicing cost and management accountant and advisor for complex issues related to indirect taxes. He is a registered valuer for securities and financial assets and an insolvency professional. With over 38 years of professional experience together with high academic qualification, Mr. Yogesh P. Chatwani sir is a very well respected professor and teacher. He is going to be interested in the session for next 2 hours. So over to you, sir. Thank you.
Thank you, Kajal madam, for that your introduction. Good evening to each one of you. Happy evening to each one of you. Namaskar to each one of you. And once again, I am getting this opportunity to meet you all through this virtual session. As we all are aware, the Divya Jyot Valuation Foundation, they are regularly arranging this type of program. So that will provide us valuable opportunity to share our knowledge with each other. After all, we all are experienced professional, and in today's world where actually the things are changing and changing very fast, so updatation of our knowledge on day-to-day basis, that is need of the hour. So in that direction, I think the Divya Jyot Valuation Foundation, they are doing the commendable job. So today's topic is on use of Excel in valuation. Now a question will come. Today we are living in the era of artificial intelligence, data analytics. We have several automated valuation model. And this reminds me actually, if you refer to the revised international valuation standard, which have been published on 31st of January 2024. So just a few months back, a couple of months back. So in that actually now we have a separate general standard on a valuation model. And in that valuation model, the use of automated valuation model, that is, am I audible? May I request one of you?
Yes, yes,
So-
audible. Yogesh sir,
Okay.
audible.
Yes, sir. Yes,
Okay,
sir.
thank you.
Yeah,
Thank you.
audible, audible.
Thank you
Audible.
for that confirmation. I am asking this because in chat box you can see one text message, a DP Singh sir. So Vadva sir, you need to check your internet connection, sir. I am having high speed internet connection. So actually rarely my voice will break. Kindly check at your end, sir. And I was just informing the use of automated valuation model that is now formally recognized under the international valuation standard. So what we are talking is use of Excel, but world has moved very fast, and now a majority of the valuation, particularly the big valuation, that is actually done through the automated valuation model. But automated valuation model, they have their benefit and their disadvantages also. Disadvantage is actually, unless you know the nitty-gritty of the valuation model, probably what and how calculation is made, that will actually be difficult to understand, challenging to understand. So in that context, perhaps the valuation model which are developed in Excel, that will actually give us plenty of opportunity to get insight into how exactly the calculations are done. So today what I am going to cover, a financial model on a valuation of equity. As we all are aware, valuation of equity, that is very important. So one financial model on a valuation of equity, starting with the techniques of financial statement analysis, ending at valuation of equity of a listed company. So that is assignment number 1 for me today. Assignment number 2, that is the valuation model on land and building, commercial building. So as we all are aware, majority of you may be from land and building. So that will be a financial model on valuation of commercial property or residential property. We will go through that. So with that brief background introduction, what I will do, I will share my Excel sheet. So just allow me 1 minute. So I hope my Excel sheet is visible to each one of you. And as you can see, what I have done here, I have taken the financial statement of a listed company. You all will appreciate that getting the financial statement of a listed company, that is not difficult. So you can get that very well from the website of that company or from the website of stock exchange where the equity shares of that company or security of that company is listed. So here is actually the financial statement, the income statement, the balance sheet, and the statement of cash flow of a listed company for a period of 6 years. So starting with the financial year 17-18, right till 2022-2023, I have taken this financial statement. So you will appreciate that income statement, balance sheet, and statement of cash flow, which we get of listed company, that is in the format which is prescribed under the provisions of the Companies Act. So Companies Act that will provide us the format, but in evaluation, this format is not useful. So for the analysis purpose, what I have done, I have here rearranged the income statement. I have rearranged the income statement. So starting with the revenue from operation, a cost of goods sold, gross profit, then employee benefit expenses, excise duty on a sale of goods, then we have the other expenses and other income, and a very important metrics in evaluation, that is the EBITDA margin, that is earning before interest, tax, depreciation, and amortization. So you all will appreciate for the purpose of time series analysis, a time series analysis, or the sectoral analysis, or the peer company analysis, whatever you name you may call it, the EBITDA margin, that is a very important matrix in evaluation. Earning before interest, so that will remove the disparity in the capital structure of a company. You all will appreciate the capital structure of a company will be comprising of debt and equity, and each company will have a separate proportion of debt and equity. Even same company, year after year, the proportion of debt and equity, that will be different. So when you will take the earning before interest, they will remove the disparity in the capital structure of the company. When you are taking the earning before tax, so that will remove the disparity in taxation. As you all are aware, the effective rate of tax will be different for each company, based on the tax credit, based on the exemption, based on the position of tax asset, tax liability. So that will be a different. Effective rate of tax will be different. Maybe the marginal rate of tax will be same, at a corporate tax rate at 20% or 25% or 30%, whatever that may be the rate. But the effective rate of tax each year of a company, that will be different based on the tax credit and exemption claimed by the company. And when you are taking the depreciation before earning before depreciation and amortization, so as you all are aware, depreciation is charged on the tangible asset, whereas on intangible asset, which is having a definite life, so in that actually we charge the amortization. So when you will take the earning before depreciation and amortization, so that will remove the disparity in the non-current asset base of a company. So very important, EBITDA margin, earning before interest, tax, depreciation, and amortization. Then we have the depreciation and amortization expenses, finance cost, exceptional item, profit before tax, earning tax expenses, and the net income. So that is our income statement. Balance sheet, so that is comprising of the non-current asset, and the current asset. So non-current asset will be comprised of tangible asset, of the financial asset, investment, and a current asset will also be comprising of the inventory and a financial asset like trade receivable, cash and cash equivalent, bank balance, loan, other financial asset, etc. So asset side of the balance sheet comprising of non-current asset and the current asset, and equity and liability. So that will have a shareholders equity, non-current liability, and the current liability. So that is the format of the income statement and a balance sheet. Now we will start with the vertical common size analysis. Vertical common size analysis, a very important for the purpose of financial statement analysis, for the purpose of making a projection. You may be aware, I am not sure, in a USA, they have a practice, all the listed company, they will invariably file the vertical common size analysis of their financial statement along with the periodical filing with the stock exchanges. In India, we do not have that practice, but vertical common size analysis that will give valuable insight into the financial statement of a company for making the projection, for making the comparison, for making the time series analysis, sectoral analysis, peer company analysis, whatever a name you may call that. So in a vertical common size analysis, what we do, revenue from operation that we take as the basis. So that is 100%. So that is the base, that is the foundation, and all other components of the income statement that we will actually compare with reference to the revenue from operation. So as you can see, the cost of goods sold of this company, a formula you can see in the formula bar. All these are based on the formula. I hope that is you can see that in the formula bar, and here also it is highlighted. So we can see the cost of goods sold of this company, that is around 75%. 75% of the revenue from operation. But there is exception in these 2 years, as you can see, that is not 75%. 2021 and 2022. So as we all are aware, these were abnormal years. We had nationwide lockdown. So a very important, before making any projection, you need to do the normalization of income. You need to perform the normalization of income. So in that, you need to remove the disparity, which is through the exceptional item. Each year, there will be a certain exceptional items. There will be a certain one-time items. There will be a certain abnormal items. So you need to remove the impact of exceptional or one-time items or abnormal items from the financial statement, and that is the normalization of earning. So here, as you can see, in 2021, the cost of goods sold, that is around 75%, 5% less than the average of 75%. And in 2022, that is compensated, that is 80%, that is 80%. So 5% more than the threshold of 75%. So we can conclude that the cost of goods sold of this company, that is around 75% of the revenue from operation. 75% from the of the revenue from operation. And when we are making the projection, we can comfortably take 75% as the cost of goods sold. Gross profit is a resultant figure, revenue from operation minus the cost of goods sold. So that is our gross profit. Employee expenses. So I will, in common size analysis, we will take more time. But in other analysis, we will go little fast because we have a lot more to cover. Employee benefit expenses, as you can see here, in absolute terms, that is increasing. Absolute terms, that is going up. So from 139 crore, that has gone up to around 195 crore. So every year you will see some increases there. But when you are comparing that in a percentage terms, percentage of the revenue from operation, so that is getting reduced. That is getting reduced from a 2.19 percentage in 2018. That has got reduced to around a 1.13 percentage. 1.13 percentage. One possible reason for this, actually, that is the automation. As we all are aware now, companies are automating their operational activity, their financial activity, and because of that, actually, less manpower is needed. Now, machine is replacing the men work. As we all are aware, we are living in the era of artificial intelligence, machine language, data analytics. More and more works are done by the robots now instead of engagement of the manpower. So that is one possible reason why it is reducing. But we can actually prepare one actually questionnaire for the management and understand the exact reason from the management of this company. Excise duty on a sale of goods. So first of all, a question will come, why excise duty, why not GST? So this is a petroleum company. As you all are aware, 5 petroleum products are kept out of the purview of GST, and therefore it is excise duty. Excise duty, as you all are aware, that is indirect tax, ad valorem levy. So that is dependent on the revenue from operation. But here, as you can see in a percentage terms, that is fluctuating. That is fluctuating. It is 2.60, 1.90 percentage, 1.97 percentage. So you need to analyze the indirect tax register of this company, the tax liability, the effective rate of excise duty, the tax credit claimed by the company, the exemptions claimed by the company, the payment of excise duty made by the company. So all that detail as a valuer, we need to go into a detail. Other expenses and other income, we do not have any other alternative but to go through each component wise. And then we have the EBITDA margin, earning before interest, tax, depreciation and amortization. Depreciation, as you can see in absolute terms, that is going up from a 272 crore, that has gone up to around 428 crore. But again, in a percentage terms, that is getting reduced. So that is actually reflecting our conclusion that the actually company is making automation of its processes, and therefore not even a machine requirement, that is a non-current asset or the tangible asset requirement, that is also getting reduced. And that we can cross-check from the balance sheet. Finance cost, as you all are aware, that is reducing, as you can see here. Absolute terms also, that is getting reduced from 196 crore, that has gone down to around 40 crore in 2023. And in a percentage terms also, that is reduced. So as you all are aware, the capital structure of a company, that will be comprising of 2 components mainly, debt and equity. And optimal level of debt and equity in a capital structure, that will reduce the cost of capital of a company. That will reduce the cost of capital of a company. So this company is not making use of the financial leverage. The proportion of debt and equity in capital structure, as we all are aware, that is making use of the financial leverage, that is not used by this company. So we again actually add this in our questionnaire and ask to the management why it is so. Exceptional item and no other alternative but to go into detail of that. And then we have the profit before tax, tax expenses, and the net income. So net income, as you can see, that is in the range of 2.44%, a maximum that is 11.19%. So that is the common size analysis of the vertical common size analysis of the income statement. In a balance sheet, what we do, total asset, that is our threshold, that is our benchmark, that is our foundation, and that we take it as 100%, and all other component that we compare with the total asset. So as you can see here, the total asset that is around 90% in 2018, and that has reduced to around 82%. So there is reduction of 8% in the non-current asset like property, plant and equipment, capital work, investment property. So one possible reason we discuss automation of the processes, but exact reason we can find out from the management of the company. And a current asset, so that is residual in nature. So that is in the range of around 11% to around 18%. So that is our breakup of the total non-current asset and the current asset. Equity share capital, as you can see, in absolute terms, there is no change. So that is around 137.68 crore. And that in a percentage terms also, there is no much difference. But other equity, that is actually going up from 1,700 crore to around 6,800 crore. So that means that this company is profitable, and not only profitable, this company is making use of effective dividend payment policy. As we all are aware, earnings of the company, so mainly there are two avenues, two alternatives which are available to the company. Number one, a distribution of the profit. So that is in the form of dividend payment to shareholder, or the profit sharing with the partners of a partnership firm. So that is a distribution of the profit, and another is a retention in the business. So retention of the earning in the business for a future growth. So these are two alternatives, and this actually earnings, this other equity is going up. That means that this company has retained a majority of its earning in the business, and therefore a company is not requiring debt in its capital structure. So that is the total equity. And the non-current liability, as you can see, from 3,291 crore, that has reduced to around 1,096 crore in 2023. So a sizable decrease is there, and that is reflected in a percentage terms also. So we discussed when we were discussing the finance cost in the income statement. So finance cost has also gone down 196 crore to 40 crore. So exact reason why company is not availing the opportunity to reduce its cost of capital, that we can find out from the management of the company. So management of the company. So that is about the a non-current liability. And current liability, so that has remained around 25%. So I hope that is useful, a vertical common size analysis. Then what we can do the horizontal common size analysis of the financial statement. So there what we do, we select a base year. So here what we have done, we have taken 2018 as the base year, and all other subsequent years earning and a cost that we have compared with the base year. So as you can see, 2019, that is 1.26 times, 2020, that is 1.66 times of 2018. So if I give you take you through here, so from revenue from operation in 2018, that is around 6,339 crore, and that has gone up to 7,962 crore in 2019. So we can say that is 1.26 times of 2018 earning. In 2019, that is 1.26 times of 2000 earning. In 2020, that is 1.66 times of 2018 earning. So like that, we can actually determine, we can compute for all other components of the income statement and the balance sheet. And wherever there are some abnormalities, so you can very well see it will be reflected 83 times, 71 times, 3,737 times. So whenever you find such abnormality, you can very well actually find out the reason. You need to go into a detail of that. So I am just informing you the techniques of making the financial statement analysis, techniques of financial statement analysis. So horizontal analysis, and then what we can do, we can do the horizontal analysis of the financial statement. So in horizontal analysis, what we do, we compare the current year earning with the immediate past year, So that can be done both in absolute as well as in a percentage terms, absolute as well as in a percentage terms. So as you can see, the revenue from operation in 2018, that was 6,339 crore, gone up to 7,962 crore. So we can conclude that in 2019, the revenue from operation that has registered a growth of around 1,623 crore, and in percentage terms, that is 25.60%. In percentage terms, that is 25.60%. So likewise, we can do for all other component of the income statement, of the balance sheet, and for each of the year. So same way, we can conclude the horizontal analysis of the income statement and the balance sheet. So far we have completed the vertical common size analysis, the horizontal analysis, the horizontal common size analysis. Now what we can do, we can find out the compounded average growth rate. Very important in valuation, a compounded average growth rate, that is actually widely used for making the projection. So as you can see, the revenue from operation of this company, that was around 6,339 crore in 2018, and that has gone up around 17,306 crore, 17,306 crore in 2023. So we can conclude that the revenue from operation of this company between 2018 and 2023, so that has registered a compounded average growth rate of 22.25%. You can very well see the formula here, and we can actually cross check this. So just allow me 1 minute. I will give you a demo of how to actually compare this, how to cross check this. So just give me a minute, and we will carry forward till 2023. And what I'm doing here, 2018 that I am taking here, 2018 I am taking here, and in next year, that is in 2019. So that is a previous year multiplied by the compounded average growth rate. And this compounded average growth rate that will remain constant. So as you can see, if I take this till last, so in 2023, that is 17,306.16, and that is the figure which is here 17,306.16. So we can very well say the compounded average growth rate. Like that, you can check of any other component. Supposing we are doing that for the depreciation expenses. So a depreciation expenses that is in 2018, that is 271.82, and the compounded average growth rate of depreciation, that is 9.52. So that we will adjust, and then we will adjust this. So so that will give us 428.26 crore in 2023. And as you can see, that is 428.26 crore in 2023. So that is the compounded average growth rate. I hope that was useful. Now a weighted moving average, so when we are making the projection, you will appreciate that here in this case, when we are making the projection of 2024 onwards, chances of repetition of 2023 number in 2024, that is more as compared to 2018 numbers in 2024. So, and each year there will be some operational difficulty. Some year of the company will not reflect the normal operational activity. So what we can do, we can assign the weight. So here actually I have assigned 29% to the latest year 2023, 24% to 2022, likewise 19, 14, 10%, 5% between 2024 and 2018. And once we assign the weight, this I have assigned on the random basis for a knowledge sharing purpose. But if we have concrete information, we can correct this weight also. So based on that, we can compute the weighted moving average, So that is compounded average growth rate, weighted moving average. Moving average, so that is simple arithmetic mean I have taken here, arithmetic mean, but moving average we can compute at an interval of 2 year, 3 year, like that. Here I have taken the moving average for a period of 6 year. Moving average for a period of 6 year. Geometric mean, or the geometric mean in investment managers, fund manager of mutual fund, of alternate investment fund, of a portfolio manager. So they are making a widespread usage of the geometric mean. So that will reflect the compounded average growth rate of the investment when actually the holding period is comprising of the multiple period or the years, So that is actually, we can make use of that for making the projection. And one thing, the geometric mean, that will always be less than the moving average. That will always be less than the moving average. So when we are making the projection, for actually conservative purpose, we can make use of the geometric mean. So that is about the geo mean. And then what we can do, we can adjust the inflation each year. As we all are aware, revenue and expenses that will be impacted by the inflation. So here I have taken and adjusted the numbers through 4% in inflation rate. So I have converted the means each component of the income statement adjusted with the inflation 4%. So that will also provide us what is the impact of inflation in the income and cost element. So that is inflation adjustment number. We can change this to 5%. So automatically all this number will undergo the change. So what we have seen so far, that is the vertical common size analysis, the horizontal analysis, the moving average, the geometric mean, the compounded average growth rate, the weighted moving average, the horizontal common size analysis, the inflation adjusted number. So all these are techniques of the financial statement analysis. All these are techniques widely used in a financial statement analysis. Then what we can do, we can have the data visualization in Excel. Actually, it is very convenient, very comfortable to make the chart, as many chart as we need actually. And I will just give a demo. You all may be familiar, but I will give you the demo of how to prepare a chart. So we have this number, and I require a chart on revenue from operation vis-a-vis EBITDA margin vis-a-vis net income. So I want to construct a chart which will provide me the information about the revenue from operation, about the EBITDA margin, and about the net income. So what I will do, I will select these years, and then this EBITDA margin, followed by this net income, followed by a net income. So once I have done that, I will go to insert tab in the Excel, and in insert tab we have this recommended chart, and in recommended chart, moment you press, so that will provide you different alternatives. So you can draw a column chart, line chart, pie chart, bar chart, area chart, the tree map, the sunburst, histogram, box and whisker. So all these different waterfall. So all these different alternatives are there, and you can make use of any of this. So supposing I am going for this column chart, so that will provide me the information. So I am going for this column chart, and I will just take here. So that is actually, I will take to the data visualization. And once we do here, so I can change the title of that. So may I request all participants please mute. So I can change the title of this, and that will provide me plenty of opportunity of design. So I can go for this, I can go for this, I can go for this. So that is very convenient to construct as many chart as we require, as many chart as we require. That is a very convenient. So I hope that was useful, the data visualization. And what we can do, we can have the ratio analysis. As you all are aware, ratio analysis, that is a very important techniques of the financial statement analysis. So we can have the liquidity ratio, current ratio, quick ratio, cash ratio, capital structure ratio, so debt to equity, a debt ratio, coverage ratio. So we can have the interest coverage ratio, profitability ratio. So we can have gross profit, operating profit, net profit, expenses. So operating expense, cost of goods sold, depreciation and amortization, activity ratio. So we can have a receivable turnover ratio, days to sales outstanding, inventory turnover, days of inventory on hand, payable turnover, days to payable outstanding, asset turnover ratio. So total asset turnover, a fixed asset turnover, current asset turnover, return on investment. So return on equity, return on total asset, operating a return, a DuPont framework, again, a very important. So that will break down the return on equity in 3 to 4 stages, either 3 or 4 stages. So here actually what I have done, I have broken down it 3 stages DuPont framework. So net income by revenue, sales by average total asset, and average total asset by average shareholder equity. So return on equity, that is the profitability measure, return on a total asset turnover measure, and a financial leverage. So that is average total asset by average shareholders equity. And then cash conversion cycle, a very important. So days of inventory on hand and days of receivable. And from there, we will reduce the days of payable outstanding. So that will provide us the cash conversion cycle. I sincerely request all participants, please mute. And this is very convenient. So that is actually, as you can see, that is formula driven. Once you have the data, you can have as many ratio as you want. That is just formula driven. You can see the formula in the formula bar. And ratio you will appreciate unless we do the time series analysis, means compare the ratio of the same company with different year, or we can do the sectoral analysis, compare the ratio of this company with the similar company who are operating in the industry. So that will provide us more insight. Merely having a ratio, that will not give us the correct picture. Like here, as we can see, the current ratio, that is 0.47 to 1. A normal range of current ratio, ideally it should be 2:1. Current asset should be twice as much as the current liability. But here that is actually just 0.47%. So we can find out the reason for this from the management of this company. We can compare this ratio with the other company who are operating in the same industry. So then only we can get a correct picture. So that is the ratio analysis. And then I am not aware whether you have made use of the Excel for making the projection. So I will highlight here. So this forecast, we will make use of the forecast. I'm sorry. What I have done here, I have taken the quarterly revenue from operation on a quarterly basis. So that is from the first quarter of 15-16 right up to 31st of March 2022. So each quarter, as you can see, that is arranged historical through color code. Actually, you will find out which are the historical results. So what we can do, supposing I need next 5-year projections of revenue from operation, next 5-year projection. So what I will do, I will take those projections from the Excel. So based on my historical data, Excel will provide me the projection for next 5 years. So in that, what I can do, I can select this historical period, that is from 30th June 2015 right up to 31st of March 2022. Then what we can do, we can go to this data tab in the Excel. In a data tab, as you can see, we have this forecast sheet. So what that function will give, that will create a new worksheet to predict the data trend. When I am clicking here, so that is providing me this data, and I need to make adjustment in the option. Now here actually it is giving me projection for just 1 year, but I need for a next 5 year. I need that for a next 5 year. So what I will do, I will adjust this period. So a starting period is 31st of March 2022. I will end this projection at 31st of March 2027. So I will just give me a minute till I adjust this date. So here is the date, 31st of March 2027. And confidence interval, very important. We all actually have one common issue. that we do not get the financial statement of the company. And whenever we get the accuracy, the reliability of the financial statement, particularly of the private company, that is always a matter of speculation. That is always a matter of speculation. So that anomaly we can adjust through this confidence interval. So supposing I am adjusting this confidence interval at say 75% and detect the seasonality. So seasonality, as we all are aware, each company will undergo the seasonality factor. So that Excel will detect the automatically. We have two options. Either we will leave it to the Excel to detect that automatically, or we can set that manually. So I will leave to Excel to detect that. And once I create this, so that is providing me this forecast actually for next 7 year, for next, 5 year, next 5 year, starting with 1st of July 2022 right up to 31st of March 2027. Now you will ask me a question, what is the authenticity of this figure? What is the authenticity? So what I will do, I will take this number. I am already having this actual sales for 2022-2023. So that I will take here the actual sales of 2022-2023. So let me adjust this. So this is my actual sales, and what I will do, I will take this three 4-quarter sale here. So that I will take here. So let me total this. So as we all are aware, the total sales, actual sale, that is 17,306 crore. And if I make total of this, so that is so as you can see, it is a lower bound. So I have got this a projection in 3 different scenarios. The forecast base case, the lower confidence bound, and the upper confidence bound. So lower confidence bound I have adjusted to 75%, and upper is our 100%. So based on this, as you can see, the 3 scenario, that is 16,933, the 20,000 and 23,000. So based on that, actually, this is closely matching. The lower case 17,306 crore is the actual sale, and projected is 16,933 crore. So you can very well make this, and through this trend line, you can actually make analysis. You can get a first-hand view of the revenue from operation of this company. So that is making use of the forecast function in the Excel. You can make projection, and there are different function which are available. So if I show you one or two, so see here, there are various functions, forecast. So if I am making a forecast linear, so that will calculate or predict a future value along a linear trend by using the existing value. So that is the use of a forecast linear function. How to do that? So I do not have this 2022 number right now, June 2022. So what I will do, I will make use of forecast linear, and once I have, it will actually show me what input I need to make. So the period for which I need the estimate, the non-wise, that is my actual revenue, and a non-X is my actual period for which I am having the detail. So once I give this formula, so that will provide me the forecast, and I can continue this till end. So there are various forecast function in the Excel, and making use of that will be very useful. So we have the forecast, ETS, seasonality, linear, all these functions are there. So that is making use of the forecast function, and how to actually compute the weighted average cost of capital. A weighted average cost of capital, that is a very important. So what I have done here, I have taken the closing of price. So for determining this company is the Gujarat Gas Limited. Gujarat Gas Limited, as we all are aware, that is one of the listed company. And what I have done, I have taken this closing price of the equity share of Gujarat Gas Limited for a period of 5 years. For a period of 5 years. So I had done this on 18th of July 2023. So for a period of 5 years, that is there. So right up to, as you can see, I have taken till the 2018. So from 2018, as you can see, I have the closing price for a period of 5 years, 2023. And similarly, I have taken the Nifty 50 figure, Nifty 50 figure, again for a period of 5 years, again for a period of 5 years. So based on this data, how to compute the weighted average cost of capital, that we will see. This will be our input. So we will start with the perpetual growth rate. We will start with the perpetual growth rate. As you all are aware, when we do the evaluation by the income approach, the DCF method, the discounted cash flow method. Any question, Vaisali madam?
Yes, in the
Yeah, go ahead,
first
madam.
row, in the first row,
Yeah.
how that figure is calculated 0.77.
Okay, so I was just coming to that. So
Acha,
that
okay.
is daily return. Since you have asked, we will complete that. So that is my daily return. That is my daily return. And a daily return, so that I have computed with the aid of log normal function. No log normal function. So why it is a log normal? So that is my compounded, that is my compounded return, compounded normalized return, compounded normalized return. A question will come, why we need the normalized compounded return, or the compounded normalized return. So you will appreciate that actually here the closing price is 464.80. That is on 18th of June 2023. Now, when the share market is open, equity will open at X price, then there will be several changes during the day, like X1, X2, X3, X4. So this is infinite, this is continuous. And at the end, that will end at 464.80. So actually, we do not have a two price detail. We have a multiple price detail. So this is not normal return. During the day, many transactions have happened. So to remove the impact of that, what we have done, we have taken the normalized compounded return. And that in Excel, for that, the function is log normal, ln function. So that will actually return the natural logarithm of a number. So the closing minus opening, and that will actually we will find a natural logarithm of that number. in during your professional journey, if you are from finance background, you must have made use of various chart in your exam, So in Excel now it is very convenient. We can make use of the log normal function to arrive at the normalized return, the compounded normalized return. So that is written. You can see the formula that is closing minus opening, and that is normalized through the log normal function. Likewise, Nifty. So I hope that is clear. Any further question, madam? Vaishali madam, any further question?
No, sir. I understood that. Thank you.
Thank you. So income approach, a DCF, as we all are aware, that is mainly divided into part. We have the explicit period and we have the terminal value beyond the explicit period. Terminal value beyond the explicit period. So these are two the components of the DCF method. And in explicit period, so that is normally of 5 years. Because beyond that it will not be feasible, it will not be possible for the valuer to make a projection, with accuracy. As you all are aware, projections are related to future, and future is uncertain. Nobody in this world can predict the future with 100% accuracy. Very difficult to predict the future. So a projection we can do at the most for next 5 years. This guidance is also there in IFRS 13 or in Ind AS 113. So IFRS 13 or Indian Accounting Standard 113, as we all are aware, that is on measurement of fair value, and there also it is provided that as far as possible the explicit period that can be of 5 years, and terminal value that is actually beyond the explicit period, and normally around 80% to 85% value that is derived through the terminal value, 80 to 85%, and explicit period that will reflect around 15 to 20%. So terminal value, what I am trying to highlight here, the terminal value that is a very important component of the DCF, Now there are multiple methods through which we can determine the terminal value, like a Gordon growth perpetuity model, or the Gordon growth stable rate model, and the exit multiples. So we can take the exit multiple for the terminal value. We will see that in the land and building valuation. So that we can take. And there are other methods also, like considering the salvage value of the project at the end of the project. So what is the salvage value? Based on that, we can arrive at the terminal value. So there are multiple methods of determining the terminal value. But most widely used method, that is the Gordon growth perpetuity model. So that is the most widely used method to derive the terminal value. And here actually, as its name suggests, a Gordon growth perpetuity model or the Gordon growth stable rate model. So here it will be assumed that the company will or the company for which we are doing the valuation, that will progress at a stable rate of growth during the period beyond explicit period. So that is actually very important to determine the rate at which the company will progress in the terminal period. So that is actually the guideline for that is the terminal growth rate. Terminal growth rate cannot be more than the growth rate of economy. Growth rate of economy under which that company is operating. So for Indian company, the growth rate, terminal growth rate, that cannot be more than the GDP growth rate of India. So that is the benchmark. That is the upper limit. And therefore, what I have done, I have taken the GDP growth rate of India from the website of World Bank. World Bank, as you all will aware, that will provide us the accurate figure. So this is the GDP growth rate of India between 2012 and 2022. So that is for a period of 11 years. And average GDP growth rate, that is 5.7%. 5.7%. So that is the upper limit for a terminal growth. That is the upper limit for a terminal growth. As per the latest survey, Indian company normally consider the terminal growth rate of 4%. So many times questions have been asked about terminal growth rate we need to consider in the DCF model. So I hope this will give you the reply. I hope that will give you the reply. Now, actually, the cost of equity, So there are multiple methods to compute the cost of equity, and one of them is the CAPM, Capital Asset Pricing Model. So that is used widely in countries like USA or European country. India also, a CAPM is used widely. Apart from that, there are other methods also. Like in India, they consider the build-up rate. Build-up rate will start with the bank rate, and then risk consideration will be added by the valuer, and we can have the hurdle rate also. Hurdle rate, as we all are aware, that is considered for the capital budgeting decision, and that is actually company specific rate, hurdle rate. According to me, that is not proper, that is debatable, but many valuer, many company, they are making use of hurdle rate as their discounting rate. So either CAPM, Capital Asset Pricing Model, build-up rate, or the hurdle rate, or many other method to derive the cost of equity. CAPM formula for that, as we all are aware, that is a risk-free rate plus beta multiplied by the equity risk premium. Risk-free rate, as you all are aware, that is the GSEC rate, government security rate, and this you can find from the website of RBI or the Clearing Corporation of India, or there are many other sources from where you can get the GSEC rate. I am not aware whether you are investing in a government security. Traditionally, the banks and financial institutions, they were the investor in a government security. But now we, the retail investor like you and me, we can also make investment in the government security. And as you all are aware, government security that comes with the sovereign guarantee. So chances of default in a government security, that is not there. Therefore, it is a risk-free. And for actually, if you intend to invest in GSEC, you can open an account with the RBI. So that is RBI direct open. You become the investor, and interest rates which are offered that is higher as compared to what is offered by the banks on a fixed deposit. So that is actually safest avenue for investing our hard-earned money. So process is very simple. Sitting at your home, no need to go to bank. Sitting at your home conveniently, or you can open the account online. So that is the risk-free rate. Beta, actually, as we all are aware, there are two types of risk which any investment will involve. We have the systematic risk and we have the unsystematic risk. Systematic risk, so that is related to the marketplace, and a measure of systematic risk, that is a beta. And unsystematic risk, that is company specific, and a measure of unsystematic risk, that is alpha. So actually, as we all are aware, in a DCF we are making use of the discount rate. A discount rate is nothing but your weighted average cost of capital. So in that we need to consider this beta and alpha. Beta is your marketplace related risk, like if the macroeconomic environment is not good, if there is recession, if bank rates are high, interest rates are high, so all the companies which are operating, that will get impacted. All the companies will be impacted. That is marketplace related. Whereas unsystematic risk, like the customer of the company are not loyal to the company, suppliers are not reliable, the board of director of the company, they are not experienced. Location of the company is not good. Morale of the employees of the company is not good. All that will impact the valuation. You will appreciate. Here I will quote the Warren Buffett. You all know Warren Buffett. I am not aware whether you are referring to his annual letter to a shareholder. So let me share this information, very important. Let me take you there. I will take just 1 minute. That is very useful. Many actually, for a moment, I will stop this and I will take you to the website. This will provide a very, this is his company, Berkshire Hathaway. Here you will find Warren Buffett letters to Berkshire shareholders. So here you can see, you will click. So you can see right from 1977 till 2023, this annual letter to shareholder you will get here. And these letters will provide you the information in a simplest possible language that actually will give you many insight in the evaluation, how investments are made. And this is just 20 to 25 pages later. Each year he is writing, he is making it a point. So if I go here and click this 2022, I hope that is visible to all of you. So that is downloading. It will take 1 minute. And as you can see, this is a performance versus S&P 500. That is the index in USA. So as you can see, this company has achieved from 1965 till 2022 a compounded growth rate of 19.8%. So you will appreciate to achieve a compounded annual growth rate of 19.8% between a period of 1965 to 2022. That is marvelous. That is, we cannot expect more than that. And this is the letter to shareholder. And every year he is writing this letter. That is worth reading according to me if you have time. That is comprising of just 10 to 15 pages each year. Go through that, you will get a very important information. So I will stop here and again we will go to my Excel file. So let me go to my Excel file. So what I was trying to inform you, Warren Buffett, that once told the financial numbers are beginning of a valuation exercise and not end of it, So if you are doing the valuation solely on the historical financial statement of a company or merely on the financial number, probably that will not give you the true picture. You also need to consider, as you all are aware, there are two factors which we consider in evaluation: the quantitative factors and the qualitative factor. Quantitative and qualitative factor. Quantitative factor will be based on numbers. Qualitative, that will include the alpha. That is what alpha is. Very important to consider that in evaluation. Unless maybe two companies are doing the same type of business, but which company will survive, that will solely depend on the skill set of the management or skill set of the members of board of director of that company. Will appreciate that. So very important to consider the company specific factor also in the evaluation. Company specific factors in the evaluation. So beta and alpha are very important. This risk-free rate plus beta multiplied by equity risk premium. So equity risk premium, that is nothing but market return minus the risk-free rate. Market return minus the risk-free rate. So just give me a minute. So for computing the market return, what I have done here, I have taken this Nifty 50 closing index, Nifty 50. Nifty 50 index, as you all are aware, that is recognized worldwide. That is the portfolio which is recognized, that is used by various fund manager. And if you want to be passive investor in stock market, try the Nifty 50. That will give you the return in long term. Nifty 50, the best portfolio. So what I have done here, I have taken this Nifty 50 figure. That is from 31st of March 2012 right up to 18th of July. These are the closing index, Nifty 50. 2012, that was 5,296, and that has gone up to around 20,000 points in 18th July 2023. Now it is much more than this. So based on that, this is the compounded average growth rate, a compounded average growth rate of a Nifty 50. So that is actually the market return. So we can say if I invest in Nifty 50, I can get compounded average growth rate of around 12%. Remember Warren Buffett company, the compounded average growth rate right from 1965 till 2023. So that was around 19%. So much higher as compared to a Nifty 50 return. That is how he is recognized world over as the best investor. So that is about the market return. And once we have this, we can compute the beta. A beta is actually in Excel, we have this slope function, slope, SLOPE. So a slope function, and that is formula driven. If I give you the slope, that will return the slope of the linear regression line through the given data. So here I have considered the data point right from 2023 till 2018, a period of 5 years. And that based on that, actually, I have got a beta of 0.05. Now, how to interpret this beta? So, as you all are aware, the market return that is always 1. Market return, that is always 1. So here what I have done, actually, I have effectively compared the volatility in the prices of Gujarat gas as compared to a volatility in a Nifty 50 daily basis for a period of 5 years. So market return or the Nifty 50, that is benchmarked at a 1. So market return will always be 1. And as compared to that, if the market return or market volatility, that will always be 1. And as compared to that, if the volatility in a price of a security, if that is less than a 1, so if that is less than a 1, so it will be considered as less volatile. So here, as we can see, volatile. So here we can see. Here we can see it is 0.05. So we can conclude that the equity of Gujarat gas, that is less volatile. Price movement in Gujarat gas, that is less as compared to a movement in a Nifty 50 index. The volatility in Nifty 50 index, the change in Nifty 50 index on a daily basis. So that is our beta. And then all other are actually formula driven. So cost of equity, that is the risk-free rate plus beta minus the equity risk premium. How to compute each one of this, I have explained that in greater detail. So I hope that was useful. So what we have completed till now, that is analysis, the common size analysis, the vertical common size analysis, the horizontal analysis, the arithmetic mean, the geometric mean, the compounded average growth rate, the weighted moving average, the horizontal common size analysis, the inflation adjusted numbers, and then we have done this ratio analysis. We have computed a various ratio. We have done the data visualization technique. We have computed the weighted average cost of capital of a company. We have also made use of the forecast function and a forecast sheet. So all this was useful. And now let me take you through the other file, which is on making the financial model, So I will stop sharing this and give me 1 minute. I will share the other file. I will take just 1 minute. Please give me 1 minute. So this is the financial model of a company called Gujarat Gas Limited. So this is the cover page of that company. Cover page will describe a brief about the operational activity of the company. That should give actually brief idea about what exactly this company is doing. So brief about this company, that is highlighted here. And then what we can do, this raw data I explained you. Then assumption. So making projection or assumption, that is the crux, that is very critical in developing a financial model. And we can do this in a very, very detailed manner. So I have done this just for a representation purpose. This is just for sharing knowledge, but you can do this projection based on the quarterly sales of the company, based on the product wise, if company is dealing in a multiple product, based on a region wise, is a company is dealing actually in a multiple region, based on seasonality concept. So each season, as we all are aware, that can be different. So what I am trying to highlight, this is a very complicated, and what I have highlighted here, that is not even a 5% of what actually is done by the valuers. So that is just to give you the idea. So here I have taken this projection under 3 different scenario: the base case scenario, bull case scenario, and bear case, lower case, upper case, and the base case. You will appreciate that when you are making the projection, and if you do only in one scenario, and if that fail, actually that projections, something happens, something, there is a war between Israel and Iran tomorrow, you will appreciate that whatever projections are made, that will actually not be the correct projection. World is changing and changing at a very, very rapid speed. So see, making a use of scenario analysis and sensitivity analysis, that is very vital in evaluation. Scenario and sensitivity analysis. So here, as you can see, the base case, bull case, and the bear case. And in that, I have taken the revenue growth rate, the other income growth rate, the cost of goods sold, that is taken as percentage of the revenue, employee benefit expenses, so that is taken again as percentage of revenue, excise duty on sale, again that is taken as percentage of revenue, other expenses percentage of revenue, tax rate percentage of earning before tax, and then you have the inventory days, account receivable days, account payable days, and that is in 3 different scenario. Bull case, that is slightly higher than base case, and bear case, that is slightly lower than the bear case. So once you have this projection, what you can do, you can construct the DCF analysis. So just give me a minute, I will adjust this. So here I have taken this forecast data. I have taken this forecast data, and based on this forecast under a different scenario. So a base case, bull case, and the bear case, my valuation will undergo change. So a bear case, whatever projection we have made in the previous sheet, that I have taken here with the help of the formula. So you can very well see the formula. Uh, 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 this Excel sheet, what I will do, as I can see, there is request from Richa Madam, Vaisali Madam. Definitely, I will share all the Excel with the organizer of this event, and in turn, you can get that. So my purpose is knowledge sharing. You will very well get that, and you can make use of that if you find that useful. If you find that useful. This is the bear case. This is the projection under the base case, and based on that, this is the historical historical income statement for a period of 5 years. Through color code, you can very well see this is my historical number, and this is my actually this is my projected, and we have this balance sheet again for a period of 5 year historical, and for a period of next 5 year projected, and we have these schedules. So that is actually a cash flow statement, and we have this supporting schedule, working capital schedule, change in a working capital, a property, plant and equipment schedule, a depreciation estimation, then capital expenditure, depreciation as percentage of opening and closing balance, the debt schedule, long-term borrowing, short-term borrowing, finance cost, and a DCF valuation. So DCF valuation, here I have taken the perpetual growth rate as a 1%, and a number of shares I have taken from the capital schedule of this company, 68.84 crore. A weighted average cost of capital, a WSEC, how to compute, I have already explained that. And current share price on this valuation date, what was the share price in the market that I have taken from the NSE. And based on that, as you can see, I have worked out the free cash flow calculation, free cash flow to firm, FCFF, that is year wise. And then we have the terminal value, as I explained you, terminal value, perpetual growth rate is 1%. All this is formula driven. And based on this, I have computed the enterprise value, X and PV function, and I have added cash and cash equivalent and reduce the debt, long-term borrowing. So that will give me the equity value, total equity value. And if I divide that equity value with a number of shares, so I will get the equity share per this is per share. This is per equity share of this company. On that day, market that was 463. Now actually this difference is on higher side, and this is under the base case. Here you can see it is 571. Moment I am changing this to a bear case, so that is 526. And a moment I am changing this to bull case, so that is 688. So there are three scenarios under which we can project this. And what we can do the sensitivity analysis. So sensitivity analysis, as we all are aware, the DCF, that is comprising of a multiple variable. There are a number of variables, multiple variable, and each variable, if that is incorrect, entire valuation will not reflect the correct picture. So what I have done here, I have done this sensitivity analysis through a weighted average cost of capital and the terminal growth rate. So here, as I have explained you, weighted average cost of capital I have taken at 9.46% and perpetual growth rate at 1%. But if a weighted average cost of capital, if that is between 10 to 14%, 10%, 11%, 12%, 13, 14%, and terminal growth rate, that is between a 10 to a 5%, what will be the price of equity share that is reflected here. As you can see, the existing is 571 under the base case. And this actually sensitivity analysis, we can do this with the data table. So in here, actually, as you can see in Excel, we have this data, and under data, we have this what if analysis. Under what if analysis, you have this important function, scenario manager. So that is for scenario analysis. Goal-seek function, so that is for making the projection under a particular situation, and data table. So data table that is used here. This dialog box is open once you click that. So here you need to give the row input cell that is related to the terminal growth rate. So that I will give at 1%. And a column input cell, so that is my weighted average cost of capital. So that is 9.46%. So once I give this input, that will provide me this prices in a different scenario. As you can see, as the discounting rate or a weighted average cost of capital that is going up, So that price is reducing. Price is reducing, and terminal growth rate as it is going up, price is increasing. So here, if I go for this 463, so as you can see, I have this 466. So if I make this the a terminal growth rate of 2% coupled with a cost of capital at 12%, I will get the price which is near to the market price, near to the market price. So I will just give you example. I am changing this to a 2% and the this discounting rate to 12%. So as you can see, now it is 466, and that is compared with the market. So that is the use of sensitivity analysis. You can have the prices under a different scenario, and the revenue and a weighted average cost of capital. Revenue and weighted average cost of capital, I have done the second sensitivity analysis. So as many sensitivity analysis as you can do with the different variable, So I hope that was useful. We have covered many aspects of the financial model for evaluation of equity. I hope that was useful. Now, two things, we will do the land and building a financial model. But prior to that, if it is convenient, we will have a short break of around 5 minutes. And before we go into the break, if you have any question, any feedback about your expectation from this session, so please inform. This Excel sheet I will definitely forward to the organizer of this event, and through them you will get. Apart from that, if you have any question, any feedback, so that is welcome. That is welcome. Otherwise, we will have a short break of 5 minutes, and we will resume the session for a remaining time. Thank you. Thank you. Any
Thank you,
question?
sir. Thank you very much. Very informative.
Thank you, sir. So kind of you, sir. Thank you. So, Sarma sir, if it is convenient, can we go in for a break of 5 minutes, sir? Health reason also it is
For 5
required.
minutes, sir.
Yes, sir. Yes, sir. Yes, sir. Yes, sir.
Okay,
Only
okay,
5
sir.
minutes.
Only 5 minutes. I will be back in
Yes.
4 minutes. Hai na?
Fine. Okay. Okay.
ஏதோ வாங்கினீங்க சார்
என்னம்மா?
உருண்டையா
ஆமாய்யா, நீ ஒண்ணு எடுத்துட்டு பாக்கி ரெண்டா கொடு.
என்ன இது
அதுக்கு என்ன உருண்டை சும்மா
So we will resume the session now. I hope all of you have rejoined. So financial models, as we all are aware, thank you, thank you. We will actually start or resume the session. So a financial model, there are different types of financial model. Only one actually we have seen, that is valuation of equity. Now what I will do, I will try to highlight actually a real property financial model. This is actually a very, very brief. We will go because time is limited. This starting with the assumption. So let me adjust this. Just give me a minute. So this is actually starting with the assumption. So that is the first sheet assumption. So here I am assuming that actually, as we all are aware, there are three approaches to evaluation. The market approach, the income approach, and the cost approach. Normally, in case of real property, the land and building, we make use of the market approach, but we can also make use of the income approach as well as the market approach. So here what I have done, I have made this assumption. Supposing there is a residential property, commercial come a residential property, and that is actually fully rented. Owner of that property has fully rented that property, that complex, and that actually expected a period of rent actually, that is I have taken it 6 years, but that I can extend up to a 15 year, a 20 year, depending upon the requirement. So here for the knowledge sharing purpose, I have taken that at 6 years, and there are three types of unit. We have the one bed apartment, second bed apartment. So there are three types of unit, and number of unit type 1, that is 50, a number of unit type 2, that is 150, a number of unit type 3, that is 80. And these figures you will find a monthly rental. I have taken just for a representation purpose, because if I am taking a very high number, so that will make the calculation complicated. This is for representation purpose. You will find this monthly rent very less, but that is actually just for a representation. So here a monthly rent I have taken at 850, at 704, and 522, and non-residential commercial. So that also depending upon the requirement, we can take that. And increase in rent. So every year, these are the expected increase in the rent, estimated increase in the lease rental every year. And then this is the estimated vacancy rate. As we all are aware, when we are dealing with this many number of properties, so always there will be a certain vacancy, a certain property will remain unoccupied. That is actually the vacancy rate. And apart from a rental income, when we have this a very big complex, we will earn a certain revenue, like the clubhouse or the common facility. Always there will be some revenue. So that is the estimation. And once we have this, then we will make, these are the assumption mainly related to the income, and then we can make assumption relating to the expenses. So that expenses, again, operating expenses divided into two parts. We have the annual operating expense increase and a management fee. So that is considered as a percentage of EGI, effective gross income, effective gross income. So that I have taken. an increase in property tax, we can do this year wise. For a representation, I have taken at the end of year 3. So based on this assumption, this is the potential gross rent. So that I have computed here, a potential gross rent. So that is nothing. First, I have computed the annual gross rent. So annual gross rent is a multiplication of this. These are monthly figure. So I have multiplied by 12 in each, as you can see in the formula bar. And this is my annual gross rent estimate, and estimate gross rent for a first year. So that is actually annual rent multiplied by the growth rate. So 2.5%. So that is my estimated gross rent of a first year. So then this is I have taken from the previous sheet the potential gross rent. I have computed the allowance for a vacancy. So that is based on the percentage of a vacancy which I have taken here. And then I have this net income, and then other income percentage I have taken here at 4.7%. So that is a net income multiplied by 4.7%. Based on that, this is my effective gross income. And expenses, so that can be a multiple expenses. These are for representative purpose only. Management fee, salary, utility, insurance, supplies, advertising, maintenance and repairs, property tax. So all this actually in a yellow cell, this is an estimated figure. So that we can take any input we can give here, and that will change the entire financial model. So based on this, actually, these are my formula driven. So that is my estimated monthly expenses. Estimated monthly expenses. All this is a formula driven. So once I have this estimated expenses, then I can prepare the operating forecast. So this is my year-wise potential rental income. And then these are from that I have reduced the vacancy allowance. So that is my net income, and I have added to that is my other income. So that is my effective gross income in a residential, in commercial, in a real property project. The effective gross income, that is a very important and critical metrics. And then I consider these expenses. That is formula driven. You can see the formula here. All this is formula driven. So that is my annual expenses, and that is total expenses, and the net operating income. So gross income minus the operating expenses, that will provide me the net operating income. And this is a very important, this is a ratio of operating expense ratio. So that is my operating expenses divided by effective gross income. So that is around 44%. So in other words, this net operating income, that is expenses are to the tune of 44% as compared to my income. So that is in the range of, as you can see, that is in the range of around 43%. So you can make a control here, expenses, cost control through this ratio. This will reflect the total operating expenses as compared to effective gross income. So that is in the range of around 41 to 44%. 41 to 44%. Now, mortgage, actually each real estate project that will be incomplete without taking the loan, borrowing, mortgage, whatever name we may call it. So here is the mortgage amount, mortgage term, period of repayment, 20 year. Interest rate I have considered at 8%. And amortization, that is amortization is the repayment schedule. So EMI on a monthly basis. So my period of amortization in a year, that is 12. That is 12. So based on that, I have computed this EMI of 66,000. So you all may be aware there are many important function in Excel like a present value. So that is a PV function. I am not aware whether you are making use of this. PMT, that is a payment or EMI, that is a payment. Then you have the future value, that is FV. Then you have the a rate function that will give you the rate of interest. So there are a different function. So a PMT function. See if I make use of that here. So a PMT, that is my payment, that you can very well find the EMI. So first you need to give the rate. So rate of interest is 8%. Then a number of period. So number of period will be 20 multiplied by 12. I will return the loan in a period of 20 year multiplied by 12. That is each month I will make payment. And then I need to give the present value. So that is 80 lakhs. A present value is 80 lakhs. So based on that, this will give me the EMI figure. Based on that, that will give me the EMI figure. Only a mistake I have done here. So that is rate is annual and installment is a monthly. So even a rate I need to convert in a monthly rate. So that is 8 divided by 12. 8 divided by 12. And a period of a return, that is 20 multiplied by 12. And then this is the amount of loan, 80 lakh, which I will get. So based on that, my monthly installment, EMI, that is 66,000. And annual debt, so that is this 66,000 multiplied by 12. Annual basis, I will return 8 lakh 2,000. So here, as you can see, this interest is total debt service, and this is principal pay. This is very important, the total debt service. And mortgage balance, that is worked out through the present value function. That is worked out through the present value function. This is detailed calculation. I will explain some other time. All this calculation very important. So here what we have found is interest paid, principal paid, total debt service. That is a total of this, and the mortgage balance. So first year 80 lakh minus I have already paid paid the present value of this amount, and based on that the mortgage balance is 7830 lakh. Then these are the cash flow before tax. So gross potential gross rate, vacancy allowance, other income, all these expenses, that will give me the net operating income, a debt service. So that is my before tax cash flow. Before tax cash flow. And then similarly, I can work out the after tax cash flow. So here a marginal tax I have considered a 40%. A depreciation basis I have considered this. A recovery period is 27.5. And based on that, I have worked out the depreciation. Depreciation basis means value of the property. And this is the number of year estimated life of the property. So that is my depreciation. And then we have the net operating income, interest, all this calculation in a detailed manner that is there. Then a sale actually, this is actually making a use of invested estimate of investor adjusted tax basis. I mean, supposing I am selling this property, purchase price is this much, selling price is this much. So all this calculation is there. And then these are the different ratio, gross rent multiplier, gross income multiplier, net income multiplier, a gross rent multiplier method. So supposing my gross rent of the annual gross rent from the property that is a 23 lakh, and I am taking the multiplier at 5 lakh, so I can conclude that my value of property is around 1,17,000. So this is the market approach of valuation. Like that, this is based on gross income. This is based on a expected gross income, and this is based on a net income. So this multiple you will get from many service provider who will give you this multiple. So based on that, you can very well derive this value. All these are formula driven. All these are formula driven. And then you can do this DCF calculation. You can find the before tax IRR. IRR is internal rate of return. Internal rate of return is nothing but rate at which the case inflow, case outflows equal to case inflows. So that is your internal rate of return. So with that, actually, in this limited time, it is over from my side. You will appreciate that the topic which we covered, that is having a very wide coverage. There are many professional courses on a development of financial model on internet. If you search, you will find many, and in a 2 hour, you will appreciate that is very limited time for this topic. But given that limitation, I tried my level best to give as much input as possible. And as promised, I will send this Excel sheet through the organizer of this event. And I thank each one of you for your attention throughout this session and making that interactive. So at the end, if you have any questions, so questions, feedback is welcome. Otherwise, we will end the session here. Otherwise, we will end the session. Thank you, sir. Thank you, Perai Sami, sir. Thank you, madam, Ruchi, madam. Thank you so much.
Thank you very much, sir.
Thank you, thank you.
Thank you very much.
Thank you.
Very good presentation, sir.
Very
I
good
will
session,
do that.
Chatwani sir. Very elaborating session.
Thank you, Kamlesh bhai, for your kind word.
Really, it was really a sensitive analysis of all us.
Yes, yes. Means a
Chatwani
lot
sir,
to
thank you
me.
very much.
Means thank you, sir. Sir, thank you. Thank you,
you.
Amit
Thank you,
ji.
sir.
Thank you, sir.
Thank you. So it seems no question. So Sarma sir, I will hand over to you, sir.
Yes, sir. Yes, sir.
Yes.
So no questions are coming up, and time is also coming to the end. So we finish this program here. I thank our speaker, sir, Chatwani sir, very much for a nice presentation. It was a new topic and you covered it quite well. Thank you very much, sir. I hope all participants are benefited from it. Thank you, participants, for participating, and kindly share your feedback. We'll be happy to have information about new topics on which you would like to have CEP. And thank you, Madam Urvashi. Thank you very much.
Thank you, sir.
Thank you.
Thank you very much.
Thank you, sir.